In 3 minutes, let's go to Bloomberg Markets Live team member Ven Ram, who joins us now with the latest on these markets. And Ven, let's start with the ECB. You have been writing about this morning. Interest rate traders are pricing almost a 65% chance of a move in early spring, which possibly doesn't sit with the expectations of a summer cut that the ECB was talking about in not so many words during the Davos event. So what kind of pushback are you expecting to see from the ECB today?
Morning, Anna. I think that the ECB is likely to reiterate that they are in no rush to cut rates. And we have seen that throughout earlier on in the cycle. Towards the end of last year, the markets were thinking the ECB will perhaps beat the Fed to a first rate cut. And then that changed. The narrative changed to a March rate cut. That has evaporated into thin air. Now, the ECB Governing Council is going to be concerned about how sticky wage inflation is, because that wage inflation is holding around 5%. And with all the tensions in the Red Sea and the Middle East, there are likely to be concerns that inflation is going to be stickier, and the last mile of inflation is not going to be easy to conquer. And therefore, the ECB is likely to reiterate its stance that the earliest possible is a rate cut in June. That means that the markets are pricing April 65% odds of a rate cut in April. That's going to evaporate into thin air later on. It's a train wreck waiting to happen, albeit in slow motion.
OK, so that's the ECB story. Over at the Fed, Ven, the story overnight, the Fed raising the rate on its emergency loan programme to stop arbitrage. This was a rate that was introduced in the aftermath of the chaos that we saw in the spring of last year around the US banking sector. What does this mean from a macro perspective?
Well, the Fed introduced this program, as you said, to assuage concerns surrounding the banking, the stability of the U.S. Midwest banks and the small and mid-sized banks. And now those banks are back on an even keel, and there is little incentive for the Fed to be offering them a lower rate. And these banks have been able to borrow at somewhere around 4.9%. That, of course, compares with the Fed's discount window, where banks will need to borrow at 5.4%. So that arbitrage, that was just free money for the banks, and there is no need for the banks, the Fed as judge, for them to get that discounted rate, and therefore they're moving to close that gap. And yeah.
So that's what they've done there. Let me just get a quick word on stocks, Ven. Interesting to see your work just yesterday talking about .com history rhyming for the NASDAQ. That sounds like a worrying thought.
It absolutely is, because if you look at previous cycles, the Nasdaq and S&P have gained in each one of those cycles, except in 2001 cycle when valuations were humongous. And that continues to be the case, which is why I'm a bit downbeat on Nasdaq and technology stocks going forward.